Everyone talks about AI like it only lives inside software, apps, and chips. But AI also needs real estate. It needs buildings, power, cooling, servers, network connections, and massive data centers that can handle the demand. That is where Equinix, ticker EQIX, becomes interesting. Equinix is not an AI company in the traditional sense. It is a data center REIT. It owns and operates the kind of physical infrastructure that cloud, enterprise data, networking, and AI workloads can depend on. So the big question is simple. Is Equinix one of the best REITs positioned for the AI boom in 2026? Or is the market already pricing in too much excitement? Because the cloud is not magic. It is someone else's data center. Equinix is a digital infrastructure REIT focused on data centers. The business is built around colocation, interconnection, cloud connectivity, enterprise data, and global infrastructure. For beginners, here's the simple version. Equinix provides places where companies can put critical technology infrastructure and connect to networks, clouds, partners, and customers. So EQIX is not selling AI software, it is not designing AI chips, and it is not a pure cloud company. It is infrastructure. It is part of the physical layer that can support cloud computing, hybrid cloud, data movement, and AI workloads. That distinction matters because AI exposure does not automatically make a company a pure AI stock. Equinix is a REIT, so investors still need to analyze revenue, AFFO, capex, debt, interest rates, and valuation. And to do that, we first need to understand how the business makes money. Equinix makes money by providing data center space, power capacity, interconnection, and digital infrastructure services. Customers use Equinix facilities to place equipment, connect with cloud providers, exchange data, and keep critical systems close to the networks they need. That creates recurring revenue. And in a data center business, recurring revenue matters because customers usually do not want to move critical infrastructure unless they have a very good reason. That creates customer stickiness. But the most interesting part of Equinix is not just the building. It is the network inside the building. If a data center connects enterprises, cloud providers, networks, partners, and digital platforms, it becomes more valuable than simple real estate. The building matters, but the network inside the building may matter even more. And this is why the AI story connects so naturally to data centers. AI needs physical infrastructure. It needs compute, power, cooling, servers, data movement, low latency, cloud access, and enterprise connectivity. When people say AI is in the cloud, what they really mean is that the workload is running on infrastructure somewhere. That infrastructure has to be built, powered, cooled, connected, and maintained. This is why data center REITs became so important in the AI conversation. AI can increase demand for capacity, but it also increases complexity. More demand may require more power, more cooling, more development, more capital, and more operational discipline. So AI creates demand, but infrastructure creates the bill. And the company that can combine data sensors with a strong interconnection ecosystem may have a real advantage. That brings us to Equinix's key differentiator. Equinix is not only selling data center space, its real advantage is interconnection. That means customers can connect to clouds, networks, partners, and other enterprises inside the Equinix ecosystem. This matters because the more valuable the ecosystem becomes, the harder it may be for customers to leave. A basic data center is real estate. An interconnected data center becomes a platform. That platform effect can create customer stickiness, recurring demand, and stronger competitive positioning. For AI and cloud workloads, connection matters. Data needs to move. Enterprises need secure access. Cloud environments need integration. And networks need low-latency connectivity. This is why Equinix is not just a data storage story. It is a digital infrastructure platform. But the story still has to show up in the financial results. In the first quarter of 2026, Equinix reported revenue of $2.444 billion. Adjusted EBITDA was $1.245 billion. Adjusted EBITDA margin reached 51%. AFFO was $1.065 billion, and AFFO per share was $10.79. These numbers matter because the AI and cloud infrastructure story has to become real cash flow. For a REIT, it is not enough to say the theme is exciting. Investors need to see the theme translate into revenue growth, margins, AFFO, and long-term returns on capital. Equinix's first quarter showed strong demand and strong profitability. But one quarter is not the whole story. So the next step is looking at guidance. What does management expect for the full year? Equinix raised its full-year 2026 financial outlook. The company expects revenue between $10.144 billion and $10.224 billion. It expects AFFO between $4.198 billion and $4.278 billion. And it expects AFFO per share between $42.31 and $43.11. The company also expects an adjusted EBITDA margin around 51%. That guidance supports the idea that demand is strong, but guidance is not a guarantee. It is a map based on current assumptions. Those assumptions can change if demand slows, construction is delayed, power is constrained, costs rise, or valuation expectations shift. So guidance helps the thesis, but investors still need to ask how Equinix will keep growing, and that leads to expansion. Data center demand may be huge, but Equinix cannot capture that demand without capacity. That means new data centers, new markets, power access, joint ventures, acquisitions, development, and disciplined capital allocation. This is where the AI story becomes more complicated. More demand is good, but serving that demand takes serious capital. Data centers are expensive to build. Power availability can be limited. Construction can take time, and returns depend on whether the company can earn enough on the capital it invests. So growth is not just about demand, it is also about execution. Data center demand is huge, but so is the capital required to serve it. And that brings us to the first major risk, capex and energy. The first major risk is capex and power. Data centers are capital-intensive assets. They require buildings, servers, cooling systems, electrical infrastructure, land, permits, and access to reliable power. AI makes this even more important. AI workloads can demand enormous computing capacity, and that usually means more power and more cooling. So the AI boom needs power before it needs hype. If power becomes hard to secure, growth can be delayed. If construction costs rise, project returns can be pressured. If capex grows too aggressively, free cash flow can become tighter. This does not mean Equinix is a bad business. It means the opportunity is expensive to capture. And when an opportunity is expensive, valuation becomes even more important. AI does not justify any price. That is one of the most important lessons for investors in 2026. Equinix can be a great data center REIT and still disappoint investors if they overpay. When a company is connected to AI, the market may price in a lot of future growth before that growth fully arrives. That creates valuation risk. Investors should look at price to AFFO, expected growth, dividend yield, margin of safety, capex needs, and future returns. The better the story sounds, the more disciplined investors need to be, because if expectations become too high, even good results may not be enough. A great data center REIT can still disappoint if investors overpay. And valuation is not the only financial risk. REIT math also depends on interest rates and cost of capital. Growth is not enough. Growth has to beat the cost of capital. This matters because Equinix is still a REIT, and REITs depend on capital. They need capital to build, expand, refinance, acquire, and fund new projects. If interest rates are high, debt can become more expensive. If capital is expensive, development returns need to be stronger. If valuation falls, issuing equity becomes less attractive. And if dividend yields across the market rise, investors may demand a better return from REITs. So even if data center demand is strong, shareholder returns still depend on capital discipline. The business can grow, but the growth has to create value after funding costs. That is why this is not just an AI story. It is also a REIT math story. And that is exactly the kind of analysis this channel focuses on. This is the kind of no-hype REIT analysis we focus on at Boring Money Wins. Not buying a stock just because it has the word AI attached to it. Not ignoring AFFO, capex, power, debt, interest rates, and valuation. And not pretending every data center company will automatically be a winner. If this kind of investing breakdown is useful, hit the like button and subscribe to the channel. It helps the channel grow, and it tells YouTube to show more practical investing content to people who want clear analysis instead of noise. Now that we understand the business, the AI opportunity, and the main risks, let's compare Equinix with other REITs. Because EQIX is not the same kind of real estate bet as a traditional income REIT. Equinix is a different REIT bet. It is not the same as realty income. Realty income is more focused on net lease income. It is not the same as Simon Property Group. Simon is tied to premium retail real estate. It is not the same as Prologis. Prologis is more about logistics, e-commerce, and industrial real estate. And it is not exactly the same as American Tower either. American Tower is more connected to cell towers, 5G, mobile data, and some data center exposure. Equinix is more directly tied to data centers, interconnection, cloud connectivity, enterprise data, and AI infrastructure. So EQIX is not a bond substitute. It is not just a simple income REIT. It is a digital infrastructure growth REIT. That can be attractive, but only for the right type of investor. Equinix may appeal to investors who want exposure to data centers, AI infrastructure, cloud growth, and digital infrastructure. It may also appeal to investors who understand that some REITs are not just about yield. Some REITs are about infrastructure growth, platform effects, and long-term demand. But investors should be careful if they're buying only because of AI hype. They should be careful if they ignore capex, careful if they ignore valuation, careful if they expect bond-like safety, and careful if they do not understand how interest rates and cost of capital affect REIT returns. Essential infrastructure is not the same as risk-free income. Equinix may be a high-quality business, but high quality still needs the right price and the right portfolio role. So now we can bring everything together. So, is Equinix winning from AI? Yes, Equinix appears well-positioned. AI needs data centers, cloud needs connectivity, enterprises need secure infrastructure, and Equinix has a strong platform built around data centers, interconnection, and global digital infrastructure. The recent results and guidance support the idea that demand remains strong. But this is not a stock to buy blindly because AI is exciting. Investors still need to analyze AFFO, capex, energy availability, debt, rates, valuation, and execution. Equinix may be one of the strongest data center REITs to study in 2026, but the best AI infrastructure investment is not the one with the loudest story. It is the one where the cash flow survives. That is the boring answer, and boring money usually wins because boring money usually survives.